95% of the FNO people, they undergo loss. But still people invest.
Still people do it. That's true.
95.
Well, I never thought that I would ever hear MS Dhoni really talk about stock markets or even FNO trading, but here he is. But what are futures and options, and why are they considered so risky? Why do 95% of people end up making losses while FNO trading? Let's find out in this video. Let's first try and understand the basics. What are derivatives? Derivatives are financial instruments just like how stocks are or even bonds are. Derivatives are those assets or financial instruments which do not have a value of their own, but actually they derive their value from an underlying asset. For instance, I'll explain to you in an example. The World Cup is on, and right now everyone is super happy with Virat Kohli's performance. Now, if Virat Kohli were to sign a bat for one of his fans, that bat would become even more valuable. The bat is made of wood, so the cost of the bat could be like any other bat. But just because Virat Kohli has signed on it, people could actually be willing to buy it for a premium, right? Now, what if sometime later Virat Kohli is not in form, he gets old, gets retired later on? What will be the premium of the bat? Will it be the same as today? Well, maybe and maybe not. Some people may say that, now I don't think Virat Kohli commands that kind of a premium, so the premium on the bat should reduce. So what's really happening here? The value of the underlying asset, in this case, Virat Kohli's charm, his performance, and the signature that holds an importance right now, as and when it goes up and down, the derivative also will fluctuate in the value. Now, the two types of derivatives that actually work in the stock markets, let's understand those: futures and options. These are the two varieties of derivatives in the markets. Futures are a type of derivatives contract agreement to buy or to sell a specific commodity or an asset at a predetermined price on a future date. Now, this future date could be this month, next month, or the far month. Usually in stock markets, there are 3 different dates that are given when you want to trade on a stock in a future space as well. This month, next month, and the far month. These are the 3 dates that usually they work on. So when the deadline of any of the delivery date comes, that is when the delivery will have to be taken. That time, you cannot say that, okay, now I'm not in the mood, now I don't feel like buying it. No. If you have signed a contract, the stock exchanges will be definitely giving you that kind of a binding agreement to the buyer and to the seller that the buyer will get the stock and the seller will receive the price. That comes under a contract or the futures contract that we are talking about. Or else, the other choice is that you can trade the futures contract. You can buy and sell just like any stock at any point of time, which is what most people do, and not wait for a delivery date and just sign it for that I'm going to be doing this for a delivery purpose or something. Now, the other derivatives is the options contract. Unlike the futures contract, which has to be executed on delivery, in options you have the option to take or not to take the delivery if you are a buyer. You have an option to do that, and that is why it becomes even more lucrative for many people. For example, let's take the stock example of Reliance Industries, the largest listed stock market stock that we have. Now, for example, its price is 2100 rupees today. Let's take it as an example. It is not there currently, but let's take it as an example. So, if a Reliance Industries stock on a spot is priced at 2100 rupees, you feel that the stock may actually go to say 2150 rupees in say next 1 month. Now, while exercising options contract, you can just by paying a 10% of the actual price of Reliance Industries, just say 200 rupees of that 2100 rupees, you can wait for that delivery date and see whether it has actually risen and you are getting the profits or you're not. Say for example, Reliance Industries stock actually jumps to 2500 rupees after that 1 month. What you have initially paid is 200 rupees for that 2100 rupees stock. So on the delivery date, what you will get is the stock for a 2300 rupees. So you actually end up getting the stock for just 2300 rupees or thereabout when the price is 2500. So you're already getting a premium. But for instance, the stock falls to 2000 rupees. In that time, remember you paid 200 rupees for the stock at 2100 rupees. Now you say that I don't want to take the delivery because you're already ending into losses. The stock has fallen by 100 rupees. But your initial loss will only be 200 rupees because that is what you paid as margin and not the entire 2100 rupees. And that is the benefit that most people get attracted to. Now, again, there are two types of options also. There is a call option, which is to exercise buying option. When you want to buy the share, you exercise the call option. And there is a put option, which means you need to sell the share. These futures and options, they also come in lot sizes. So in stock markets, in the cash market, what you can do is you can just buy, say, a single share also, 2 shares, 3 shares, 10 shares, 20 shares, whichever number of shares that you want to really buy. But it does not happen like that in the futures and options contracts because these come in lot sizes and they all are varying for every company that is listed on the stock markets. Say for Reliance Industries, it may be 200, 250 in actual, but I'm taking an example of, say, 100 shares. Now, what is the difference between futures and options? Let's try and understand that. The main point of difference lies in the obligation of the buyer and the seller. In a futures contract, both the buyer and the seller of the contract are obligated to complete the transaction on the delivery date. However, in options contract, the buyer of the contract has the right and not the obligation to really execute the contract. So what are the risks involved here? Let's try and understand that, because we are saying that 90-95% of the people, they lose money in F&O trading. Why do we say that? Let's listen to the risk very, very carefully. The risk involved in a futures contract is higher than the risks involved in an options contract. Why is that so? Well, that is because of the degree of the profit or the loss that is possible. In a futures contract, there is unlimited potential for both profit and for loss. In an options contract, the potential for profit is unlimited, but the loss is limited to the premium that you have paid. So, for one Reliance lot in futures, for example, a lot is for, say, 100 shares for Reliance Industries, the current value 2100 rupees, and by just paying a margin of, say, 10%, that's 200 rupees, you just paid 20,000 rupees. But you end up getting Reliance future lot, which is worth over 2 lakh rupees in just 20,000 rupees. Now, if Reliance share really jumps by 200 rupees in that period, how much profit do you make? You make 200 rupees into the number of shares in that one lot that you own, that is 100, 20,000 rupees. That is the profit that you have. But by chance, if the shares fall by 200 rupees, from 2100 rupees to 1900 rupees, your loss will be 20,000 rupees. Now, the problem will happen if the stock falls even more. 20,000 is what you had initially paid, thinking that the stock will go higher, but the stock goes down. If the stock falls by, say, 300 rupees, from 2100 rupees to 1800 rupees, your loss is per share 300 rupees. And then this will be calculated into the lot size. Your total loss will be 30,000 rupees. Remember, you had initially paid 20,000 rupees, but now you will be forced to bear more loss than your initial investment, 10,000 rupees more, and you end up losing 30,000 rupees in all. Now, what happens in cash market? If you buy a stock for 20,000 rupees, you end up, say for example, if the stock goes down and you lose your entire money, you will at the most lose money of whatever you have put in. 20,000 rupees gone, completely gone. But in futures and options, the loss can be far greater and far more worse than what your initial investment is. Your loss can be in multiples of your investment if the stock falls more than your estimate, and which is why it is considered an absolute risky proposition to invest in F&O, especially when you are just speculating and you are entering into a sphere where you do not know what is really going to happen, until and unless you are a deep chartist who knows how to study the charts, who knows how to study the kind of prices and the movement of the prices historically, and you know what exactly is really happening. that this is a space that you should stay away from. And that is what SEBI has also constantly said, that, you know, in case you're a first time investor, just because of the lure of putting in less money, of course there is a potential of higher profits, but the risk of downside is also even more, which is why it is said, start off with mutual funds if you are a fresher. Absolutely, do not even invest in stocks directly on your own. Get a financial advisor, get a mutual fund expert to really guide you through your investments. So for such videos, in case you want to understand more about the stock market, certain topics that you need an explanation of, you can write to us on the comments below and we will get you such insightful videos even going forward. Many thanks for tuning in to this one.